Because it deals with risk, and you need a, what type of license? You need a minimum of a Series 6 and a Series 63 license to do variable annuities. And as variable annuities, for most of your clients, is it something that they would want? What's the big upside of having a variable, just so you guys know that the fact that you're selling it, what's a big upside for having a variable annuity in a down economy? So let's say your variable annuity had $100,000, right? What happens if the stock market crash and now it's worth 50? At least the kid still has a financial future, okay? All right. So, on the flip side, come to find out, we got a bunch of people that work for utility companies. People work for the cities, the municipalities. What's the number one employer in the country? What's the number one employer in the United States of America? It's the federal government. And in most cities and states, the largest employers in those cities and states are usually the cities or state government. Okay? And some of them are, for example, my mother, she was a city nurse. My mother worked for the city of Chicago. I'm looking for the other desks that you avoided when you walked into the bank. And one of those desks are the financial services guys that do 401k rollovers. Okay? So you do a 401k rollover, say it's $100,000 goes into here. And what type of product do you use? An index annuity. Okay? What's another style of annuity? Fixed. What's another style of annuity? Variable. Do we do variable? No, we don't do variable. Why don't we do variable? So actually, it's actually whole life. It's actually whole life. Okay? It's most conservative and guaranteed of the 3 or 4 we just mentioned. The second one would be universal life, and the third, not as conservative but a little bit more upside, would be the IOL. So age appropriateness is also what you're looking for in terms of suitability for these particular products. Okay? Aren't you glad you're going to train a trainer? Yeah. That's why we teach you these things. Okay. Instead of selling at 70, before any politician can put it together policy, you need to be successful before that action happens. Okay, so this is a market you can tap. Why am I poking at the hood? Because here's what I realized in Chicago. I'm in the hood, right? Yeah, guys, on a serious note, last year we lost 2 of our agents due to gun violence in Chicago. Okay, from the hood. Both are getting carjacked. And one was picking up his son, and baby mama's boyfriend didn't agree with him, pulled out his gat, shot him in the head. Okay, the term policy? Probably not, because it'll probably expire in 5 or 10 years, and the premium is massively expensive. If grandma doesn't die within inside the term, you just paid for it, nothing. Okay? Or you want permanent? What's the different versions of permanent life insurance policy? Whole life, universal life, final expense, which is a version of whole life, or index universal life. Okay, what's the most conservative and guaranteed of the three or four we just mentioned? 1,000 is there. So cash, option A, just leave the cash, right? Or option B, she can put this $50,000 into a into a life insurance policy. Okay, but what type of index? Because now we have many different types of life insurance policy, right? So we have 2 styles. We have term or perm. So term insurance let's say grandma's 75 years old. Do you want to sell a 75-year-old? Second play to tap into this $35 trillion market. So number 1, older Americans with money they want to leave behind to their kids. Second play, people that are saving for retirement. They are still in the accumulation phase of retirement, right? What's the 4 major phases of retirement planning? Number 1 is the contribution phase. Second phase is the accumulation phase. Third phase is the distribution phase. And number 4 phase is life insurance is the most tax efficient way to pass money from one generation to the other without paying a dime in tax or any disruption in a stock portfolio. Because what happens tomorrow if the stock market crashes and grandma had this in a brokerage account? What would happen to the $50,000? Done. Okay. Tomorrow the stock market crashes. $50,000 in a life insurance policy. Guaranteed contract. Okay, so that's one play. You guys got me so far? That's one play. Now this is a life insurance policy. Under what IRS code does a life insurance policy say to the IRS you cannot tax this amount? 101A. Okay, IRS code 101A says any money that you receive from a life insurance policy, you do not pay a dime in tax. Okay? 7702 is money that grows inside a policy. Just like you have a $100,000 rollover, because this is what I'm earning on this rollover. I'm not charging it to you, but the insurance company's paying in. And then how do the insurance companies pay you? From what budget? Transfer phase of retirement planning, right? So I want to contribute to my retirement. I want to have my money accumulate. I want to distribute my money for income, and whatever's left, I pass on to the next generation. 4 phases of retirement planning. You guys got it? Okay. So let's say you're in the contribution and accumulation phase of retirement. You got somebody there with that worked at a company for 10, 15, 20 years, and they left the company due to COVID. They got laid off. They got fired because they don't want to take the vaccine. Minimum floor. 0 becomes your? 0. Now, do you have to pay for that? No. But do you have to pay for it in a variable annuity? Yes. So in other words, you are providing a product that mimics what a variable annuity would do in case a client were to pass away in a down economy without having to pay additional fees. Okay? And so number one, also here, this $100,000. People say annuities have a lot of fees, have a lot of fees, have a lot of fees. What are they referencing to really? What fees are they referencing to? Non-MEC guideline means that it doesn't violate the modified endowment contract guidelines, meaning there's a fancy rule out there that was developed called TAMRA, okay? Which meant that back then, Wall Street and the banks would say, shit, man, we love this tax haven. And what were the interest rates back in the early 80s? Was it low or high? Yeah, kind of like what we're experiencing right now. So people would move their money from the banks and brokerages into life insurance policies because they would be getting 8, 9, 10, 20. Thankfully, they had, beforehand, they would not have ever had life insurance. And so I'm on the uncomfortable conversation with the insurance company. Hey, make sure the death benefit is paid out. Make sure that, guess what? They both had in-force life insurance. Not that we ever replace daddy not being here, but thankfully the mom's got cash to raise a kid. They can raise a kid and get him out of the hood and live in the suburbs and put him in private school and still do ballet and jazz and whatever. Crypto out there before it explodes up. It's not going to happen. And then even if it became a crypto gain, is crypto now taxable? Yeah, cryptocurrency is now taxable. So you even had $100,000 in crypto gain. If it's short-term or long-term gain, if it's short-term gain, you can pay a higher tax rate. Long-term gain, smaller tax rate of 20%. But still, what rate of return are you going to try to find for grandma that's going to double $50,000, $100,000 from day one and then not pay a dime in tax? So life insurance, for those of you who don't know this, the financial advisor, regardless of your account is up or down, you're still paying the fee. How much fees do you charge your clients for having their money with you inside index annuity? 0. So are you saving clients a lot of money? And are you charging them a commission? 0. Now, with the new rule that was put out, if you're doing a rollover into a qualified plan, you now have to disclose what? How much? Now you have to disclose your commission. With the new rule that came out, right? Like, shit, do I really? Hey, Mr. and Mrs. Client, how many people at 0.9? So 9/11? So in approximately 9 years, that 50,000 will feel like 25,000. So by the way, that goes opposite too. So the Rule 72 works in your favor if you're earning 7.9% interest. You guys follow me? If you're earning 7.9% interest, your 50,000 will be closer to 100,000 in 9 point. How was it? 9.1. So in 9.1 years, 5-year-old in IUL, which they need some form of guarantees and safety. Okay, so now, how many guys have ever ran a life insurance policy for somebody that's older? You shove $50,000 in there, and by this $50,000 in there, what will it start creating? What type of contract? Is it taxable policy or non-taxable policy? If you just shove $50,000 there based on guidelines single premium. So in other words, I just want to shove $50,000 in there and not ever have to pay a life insurance premium ever again. What essentially have you then created? Think these closeouts are important? Yeah. So anyway, he gets a policy on closeout night. We never thought in 18 months later, at 38 years old, he would suffer a stroke. Mom calls, hey, let me talk to dad. I don't know, mommy, daddy fell asleep on the floor. What? She gets home, he's in the middle of having a stroke. Calls 911, airlift him out to Northwestern Hospital. Anyway, make a long story short, thankfully he survives. He was in bad shape though. He was in bad shape. Dustin recovered from stroke. He had okay, that's a different tax code. But 101A says money that you receive as a death benefit, you do not pay a dime in tax. Any money that you receive as a living benefit, you do not pay a dime in tax. So for example, the guy that built my website, Money Smart Guy, he started reading my videos and watching my videos and reading my content. He said, hey man, I think I need a policy from you. Why? because I'm a dad. I'm from Trinidad and Tobago. I got 4 kids. I'm married to a sister girl from the south side of Chicago. I got 2 employees that work for me. They're financially dependent upon me, creating jobs and income. So anyway, we get them a policy and closeout night. So you don't, it's what? There's a Foot Locker there and a House of Hoops. And if you guys know anything about the Foot Locker brand, that's like the upgraded Foot Locker, right? You get Foot Locker, boom, House of Hoops. Okay? It's not just your regular Foot Locker brand. They got the top of the line, top shelf Foot Locker inside. I used to go down in the west side of Chicago, in barbershops. Used to do these BMPs. All these guys cutting hair. Oh, that makes sense. That makes sense. Okay, let me set. Guys, that's what we were doing in Chicago. Can we do the same thing here in Dallas? Because there's how much money inside the hood. There's Rule of 72 says my 50,000, if it's growing at 7.9% interest, will be 100,000 in 7.9 years, or 9.1 years. I'm missing my numbers. Right? Yeah, I just confuse you guys. So back to the Rule of 72, right? 72, 7.9% inflation means that money will double or devalue in 9.1 years. So in other words, if you have a 7.9% interest working in your favor inside these policies, inside the accounts that you set up for clients, guess what? Their 50,000 will double 4% return inside life insurance policies. So they're earning this high interest rate, but not paying a dime in tax inside old whole life and universal life policies. Until they started creating this law, TAMRA, say, hey, you have to have a minimum amount of life insurance on the policy. You just can't have a $1,000 policy. You just can't have a $1,000 policy and have $50,000 in it. You have to have a proportionate amount of life insurance in the policy if you're going to have X amount of cash. That's what the TAMRA tax law created, okay? So if grandma was to put 50,000 to 100,000 in 9.1 years, so far so good? If the inflation rate stays the same, in the same 9.1 years, your 50,000 will be worth 25,000 in 9.1 years. Does that make sense? Yes. So grandma's got a choice, okay? A, she leaves behind cash. Whenever she dies, maybe in 9.1 years, if inflation stays the same, that 50, the Merrill Lynch is helping. Anybody's got $250,000 and above. Otherwise, you don't talk to somebody at Merrill Lynch, at Bank of America, who's helping a client with $50,000, $80,000, $100,000, $125,000. Nobody. You know who is? You and I. So here, if you want to help this demographic, I got 3 case studies for you. 3 case studies for you. Number 1, how many guys may have a grandma or grandpa that says, hey, you know, I want to leave my kids behind an inheritance. I want to leave them some cash. There's $35 trillion. So in other words, there's a vast amount of money across the United States of America. Now, here's the reality. Some of you guys will never touch a whale. You probably never touch a client with $10 million inside their retirement account. But you can touch a lot of people with $200,000 in a retirement plan. You can touch a lot of people with $300,000 in a retirement plan. You can touch a lot of people with $100,000 in retirement. You can touch a lot of people with $500,000 in a retirement plan. And to them, in the hood, they are millionaires. Yes? That's our crusade. Who's helping them? Nobody but you and I. You know why? $1,000 less valuable tomorrow than it is today. Because $50,000 is going to feel like $45,000. It's going to feel like $40,000. So grandma thinks $50,000 is a lot of money, but she doesn't pass away today, but she passed away 10 years from now. Think about this real quick. Rule of 72. You divide 7.9% interest into 72. What's the math on that? Okay, it's little over 6 years. So 72 divided by 7. People that are after, that's it. People that are here not necessarily for the money, but here for, listen, I got a crusade that we got to fulfill. So this is the play. So instead of leaving cash to the next generation, you stuff it inside life insurance. Here's why. Day one, what's this $50,000 worth from day one? Worth $100,000. So where is grandma going to find an investment that from day one, with no risk, is going to double in day one? Zero. Even if you find the best knowledge into whatever variation of policy that you might think is more conservative, whether it be whole life or universal life, it may not be IUL, okay? What do you think this $50,000 will turn into immediately from day one, assuming grandma qualifies for the policy? So some of you life insurance agents, no. Well, how much do you guys think it would be worth? I'd say 100 grand. So this policy, immediately from day one, assuming grandma qualified for the life insurance policy, this would be a $100,000 life insurance policy. Okay, right? Crack babies would literally be born in my mother's hospital and trying to resuscitate them, wean them off of crack, and sad state, premature babies, you name it, okay? So you go to Cook County for that type of show, the type of training, that type of show. Okay, so guess what happened though to people working in The hood, city hospitals, the police departments, right? They fund their retirement plan. So there's a lot of money in the hood. In the city of Chicago, if you go down Madison and Pulaski, that's West Side, right? Guess an IRA. What does IRA stand for? Individual retirement account. How many guys never knew what an IRA stood for? How many guys thought IRA was somebody's name? By the way, this is part of financial education. Okay? So good for you guys for wanting to come here and wanting to learn. Okay? So you roll it over into an IRA. By the way, who also does that? Who competes with you for this type of transaction with your clients in your community? The banks. So you go into a bank, you're looking for, okay, I'm not just looking for the teller. Okay. We learned from our last mid-year event, our last big event up in Daytona Beach, Florida. Who do we learn from an annuity standpoint? A guy named Tom Hegner, probably the world's most foremost authority in terms of annuities. So Kendrick, can you move this podium, bro? Thanks, bro. So he says, you got an option. You can leave $50,000 of cash in a bank, in a CD, a checking account, rubber bands, coffee can, right? You can leave this to the kids. But what's the problem with leaving $50,000 of cash to the kids? They receive $50,000. Based on inflation, it's $50,000. In Cook County Hospital, my mother got a pension from the hood. For example, if you wanted to become a paramedic in the military, guess what city hospital they'd send you for training? For gunshot wounds. Chicago's Cook County, where my mother was a nurse at. Right? I would visit my mother at her hospital because my mother's a NICU, PICU. You guys know what that is? So the babies, right? Intensive care for the babies. I'd go visit her and see these babies literally smaller than the size of my hand with 15 daggone tubes coming out of their bodies because the kid's addicted to crack. You've created who said that? MEC. You've created a modified endowment contract, which means that any growth in there, if you withdraw it, is then taxable. Okay? You're on this stuff, okay? And you just passed your license too. Good for you. Okay. So a modified endowment contract means, sure, the money's inside the policy, but any gains, if you were to withdraw it, you have to pay what? Okay. So when we set up life insurance policy, we set what we call a non-MEC. So when Jesse set up the policy for this guy, right? He set up a guideline. 1,000, you died. What would your beneficiary receive? In a variable annuity. Your beneficiary actually received 100,000. Right? So in a variable annuity, the fee that you pay for is for your beneficiary to receive whatever you put in there, regardless if the stock market drops. Okay? So that's the inherent insurance. Now, inside an index annuity, will this ever happen inside an index annuity? Because there's a guarantee, whatever the case may be. But you got 100 grand in here. Okay? What's one play that you guys can do if somebody's got $100,000 or $50,000 or $250,000 or $50,000 in a former 401k plan at a former employer? What's the move? The annuity is a funding vehicle, but what do you call that? It's called a rollover. Everybody say rollover. Rollover. Okay. And you roll over into what type of tax structure? They're really referencing, and by what's the maintenance fee? What fee do you pay for an insurance company to manage $100,000? Zero. You pay zero fees. How much commissions does a client pay you for $100,000 rollover? Zero. Okay, financial advisor. How much do they have to pay the financial advisor to manage $100,000? At least 1.5%. Some guys charge 3%. So in other words, you're paying fees on the amount that's there with a life insurance policy. $200,000 is paid to him without paying a dime in tax. Guess what today he is? He is one of our marketing directors. And it's Kenya, his wife, like, can nobody tell me nothing about life insurance? Can nobody tell me nothing about PHP? It saved my lives. Because we were bold enough to show up on Steak and Close at 1:59 a.m. in the morning, right, Andre Ducille? Close the doggone life insurance policy. That's it. Who's selling somebody a life insurance policy at 1 o'clock in the morning?